Hello, everyone. Thanks for checking in. Grayson Geiler here with SES Services Weekly. I like to get some news from the financial media, going a little further into depth in a weekly update. Today, I would like to talk about the debt ceiling that we just hit last week. Okay, so everyone knows that our federal government borrows a lot of money. Through the years, there's always a borrowing limit that Congress sets, and then they get together and they agree to keep raising it. So last week we hit the debt limit, 31.4 trillion. You heard me right, 31.4 trillion the US government owes. Um, and sometimes when you look at the magnitude of that, it's absolutely enormous compared to other world economies, just in dollar value, just in the size of the debt. But don't forget, we are the largest economy in the world. So sometimes the size can be a little bit of an illusion. So a better number that I like to take a look at, just to show you, is the debt to GDP. And so this is a more accurate representation of the debt overload that the government has acquired. In 2010, a couple of economists, Reinhard and Rogoff, put together a paper that talked about, in the last 200 years around the world, the debts that sovereign governments would take on. And there seemed to be something that about 90% of a country's GDP in sovereign debt would start to cause problems. That much debt becomes kind of an overload where there's interest to be paid on that debt. So more taxation has to come out from the populace by the government. It kind of weighs down the economy, and it starts to become too much of a burden. So again, historically, according to Reinhard and Rogoff, around 90% of GDP, some things would typically happen: a restructuring of the debt, full on default on the debt. Well, as you can see by the numbers you're looking at on the screen here, we're way past 90% of our GDP, but it hasn't been that way for that long. Obviously, the 2008 was an absolute rocket launch of our debt to GDP, from 60% to 100%. And we kind of went sideways and held together for a while. And of course, this last performance with government performance of loading on a whole bunch more debt and handing it out in various ways. So now we're sitting at some 120% of our GDP in debt. We really couldn't find historical examples other than let me rephrase that. Throughout history, of course, governments, that's what they do. They get over indebted. To come out of that debt through growth, not through a restructuring or a default, just doesn't happen that often when you're talking about this percentage of a GDP. The British, after the Napoleonic Wars, is the one example historically. Some historians have them over 200% of their GDP in sovereign debt, and they grew their way out of it. They didn't have to default. That was at the beginning of the Industrial Revolution. So that is one example that we did find. Not a lot of them out there, really not more than one that I could find out there. But also keep in mind, back then they didn't have the sort of social programs that we have now. They didn't have the overload of Social Security and Medicare, which are getting very bad, as far as if you were talking about a generally accepted accounting standard. The federal government is insolvent with the size of the unfunded liabilities. But of course, as time goes on, some of those things can change. They can get the Treasury can get the Federal Reserve to print a lot of money, try to inflate their way out of debt. But these are staggering numbers. So Congress is going back and forth, and they've got the Treasury playing games to avoid any sort of a default. the Treasury is saying that Congress is going to have to figure something out now that we've hit this debt limit, can't borrow any more money, that there's going to have to be something figured out by June. It seems like there's a bigger window of playing shell games than historically when we hit up to the debt limit, but I don't remember precisely. So, I mean, it can look really daunting, but before we go running out and sell everything and run up into the hills, into our compounds with machine gun turrets, remember that, history rhymes, it doesn't repeat. Haven't had a situation where the world reserve currency, without any new frontiers, without any alternatives, was set up the way the US dollar is. So that is an advantage, of course. Of course, we're going to overuse that advantage. But it's still here. And when you look at the way the Federal Reserve is clearly still leading the world in monetary policies, it does seem that we still have some time left in our currency advantage. Saw some news that Argentina and Brazil are going to put together a new currency for South America, and they are going to, lots of doomsday economists are talking about that's the end. That is the de-dollarization of the world's economy. And, right now that's clearly just talk. I mean, when you look at Argentina, and if you're a longtime reader of what we write, we've highlighted Argentina as the poster child of bad monetary policy a number of times. I mean, since they got their independence from the Spanish just after the turn of the 19th century, they've defaulted or restructured their debt 9 times. Their currency is an absolute train wreck right now. So for them to say with Brazil, who's having some big problems with government structure, some corruption, for them to say we're de-dollarizing and we're going to create this unicorns and ice cream world of our own South American currency, looks to me a whole lot more like talk, until proven differently. And that's kind of along the same lines. People have been talking for quite some time that the Russians and the Chinese are going to do the same, create their own payment systems, create their own currencies, maybe gold-backed currencies and all those sorts of things away from the US dollar. And, it's same sort of situation. Again, I see everybody gets a little afraid because I'm not saying that the US is playing its cards well, considering the advantages we have. But still, remember, the Chinese and the Russians, the only time they can agree on anything is when they're fighting against America. And if the fighting stops and they're trying to coordinate things together, I don't have a lot of they don't have a lot of confidence in each other. They're not going to sit around and save their resources denominated in each other's currencies. They're not going to do it. Will they be able to come up with their own currency? They're not even talking about that right now. And everybody's still talking about different cryptocurrencies. The Norwegians have an electronic currency going completely away from cash. So there is a lot going on. But I think, the stock and bond markets are kind of proving me right. Over the last few months, I've been saying I think the negativity is overdone. I don't like, for the long term, especially looking at a chart like this, it's ridiculous. Debt to GDP like this for the world's reserve currency and strongest economy, that's terrible. But again, with all the doomsday stuff going on out there, I think it's drastically overdone, and things really aren't coming apart. Now, does that mean that at this point we need to pile into all the risk assets we can? For the medium to long term, I still see some huge headwinds, and one of the big things that I'm as people's fears abating a little bit, I start to get more nervous. Counterintuitively, but that's the way it seems to make sense to me. Going forward, we still have interest rates on the front end of the curve higher than they've been in more than a decade. There's a big debt overload. That means somebody has to pay interest on debt. And I'm not just talking about this 31 trillion that you're looking at on this chart, debt to GDP for the US. I'm talking about corporations. I'm talking about families. You've seen some of the mortgage numbers, the new houses built and paid for at these 6.5. I've seen some 7% mortgages. It just doesn't catch fire the way it did when the 30-year fixed mortgages were in the twos. So there are some serious headwinds. And if we're really piling into, for example, the S&P 500 in stocks, well, you're really depending on interest rates coming back down. And it seems to me, especially with the talk, the Fed has been pretty consistent, at least in the last 8 or 10 months, on what they said and what they've done. And they say they're going to keep interest rates higher for longer. Well, the only way they would stop that and lower interest rates is if you have quite a recession going on. And I'm not sure that's a great strategy to pile into stocks. And again, I'm not saying sell everything and go running up into the hills. But the more excited people get about there not being a recession, about the Federal Reserve stopping raising interest rates, maybe even lowering interest rates, the more nervous I'm going to get. Right now, it's still just kind of some of the pressure coming off the market for the negativity of, some people got disappointed that we didn't get a Santa Claus rally last year. Well, this is one of the best Januaries in a long, long time. So the pressure comes off again. But going forward, these higher interest rates are going to be like ankle weights, especially on the levered up stocks, on the tech stocks, that sort of thing. So we need to keep that in mind. It's as far as the debt ceiling itself, my guess is we'll just have political grandstanding on both sides of the aisle till later in the year when it's really crunch time and something needs to happen. They're just going to raise the debt ceiling. I certainly hope they don't throw all caution to the wind and remove any concept of the debt ceiling. That would be like a poker player going on tilt, if you know what that means. Well, again, the pressure's coming off the market. Not super excited for a huge raging bull market going forward at all. But again, I think negativity is overdone, even though it is starting to subside. So keep that in mind, because I've been saying this for months now that I thought the negativity was overdone, and I'm not going to keep saying that. Hey, if we can help, here's our information. We'd be more than happy to sit down with you for no obligation consultation. If you like the content that we're putting out, hit like, smash the like button, hit the subscribe button, send it to friends, family. Reach out to us if you need some help, and I hope to see you next week. Thanks for your time.